For several years now, economists have raised red flags over record high household debt in this country. But new numbers suggest Canadians aren't heeding the warnings and paying down their debts. According to Statistics Canada, the debt-to-income ratio in the third quarter of this year was 177.5%. That means for every dollar Canadians earn, they owe an average of $1.77. That's despite higher borrowing costs. The Bank of Canada has raised interest rates from 0.5% to 1.7% over the past year and a half. So how much of a concern is this? Brett House is Deputy Chief Economist at Scotiabank Economics, and he joins us now from Toronto. Hey, Brett, great to see you again.
Good evening. Good to see you.
How worried should Canadians be about these revised numbers for debt?
Well, the debt-to-income ratio that we have is one of the highest we've had in our history and compares not terribly well with the United States just prior to the global financial crisis in 2007, 2008. But one thing to keep in mind is that the revision that just occurred doesn't reflect a top-line increase in the stock of debt numbers. What it actually reflects is that we got tax returns from 2016 in, and so now we have actual numbers rather than estimates from surveys to measure the bottom line income number in that ratio. So what's changed here is that in recent years, Canadians earned slightly less in their incomes than we had previously estimated, and so that's pushed this ratio up. It's not the case that the stock of debt has gone up in an appreciable way.
So what does the ratio, what are the implications of the ratio, though, for the economy writ large?
Well, what that ratio is trying to capture is if in a single year an average household had to pay off all of its debts, would it be able to on the disposable income that has at its ready liquidity? And in any given year, what that ratio implies right now is that it would take almost a year and 3/4 of income to pay off one's household debt. But the thing is, that's an interesting ratio, but it's not necessarily the best indicator of the solvency of Canadian households. Because at the same time, if you look at like for like, the stock of debt against the total stock of assets that Canadians have, and assess what is their net worth. Right now, assets to total debt are about 8 times the size of total debt. And that asset to liabilities ratio has remained more or less constant over time. And that's really the better measure of Canadian household solvency.
So does that mean we should not be as worried? I'm just trying to, for those of us who don't have your economist brain, should we be using the income to debt ratio, or should we be looking at our assets to our debt?
Well, I think we should be looking at a variety of metrics here. So the debt to income ratio is an important first place to start, and then put it into context to say, well, what is happening on the entirety of Canadian household balance sheets, and what does our net worth look like? And when we look at that broader picture, it puts that first number into context and says, yes, debt numbers as measured against personal incomes are high, but at the same time, assets have gone up an awful lot over the last few years too. And so if Canadians really were put in a position where they had to bring those debt numbers down, they have the economic means to do so.
Is that why they're not bringing them down? And I ask because I feel like we've had this conversation a lot over a number of years. I remember when the Bank of Canada governor was signaling this years and years ago. This is a big issue. Different governments have been seized with the issue. Is there a reason that sort of Canadians don't appear to be heeding the warning, or are they?
Well, one of the reasons they haven't brought them down is because interest rates are still near historic lows. One of the things we've talked about before is that the headline policy rate, the overnight rate target that the Bank of Canada has set at 1.75%, is lower than the headline rate of inflation. So in those circumstances, if you can borrow at that policy rate, you're actually being paid to take out debt. So this is a situation where the mix of policies is still really encouraging people to go into greater debt. At the same time, though, there have been a number of policy measures brought in that have curbed the growth of that debt over time. So you're not seeing the pace of new loans being written at the same speed that you saw a few years ago. And we've had about 8 different tightening of those rules over the last 5-6 years or so.
Are you talking about, like, for example, mortgage rules?
Yeah, for instance, the mortgage rules, which mean that if you take out a new mortgage now, you have to be able to prove that your combination of assets and income would enable you to sustain payments on that mortgage, even if interest rates go up a full 2 percentage points from where they are at the time that you take out the mortgage. That makes the debt that is being taken on a lot more resilient than has been the case in the past.
Is there any necessity for more policy measures like that, or other ones directed at the level of debt in this country?
Well, you've got a few things happening at the same time that should help continue to improve the appearance of some of these metrics. One is that decreasing growth in new loans, which is being driven both by that tightening in policy and by the increases that we've had in place and that we're expecting from the Bank of Canada. I think what you are seeing is very close monitoring by policymakers, and I think if they see parts of the household sector in Canada that are starting to experience greater stress, they will move on the policy front. But right now, it isn't clear that additional tightening is required because we are seeing the response in credit growth rates that we would expect.
Before I let you go, I do want to ask you about the markets today because it was another not so pretty day. The Dow fell 508 points or 2.1%. The S&P 500 lost over 2% and retreated to its lowest level of the year. And the NASDAQ joined the Dow and S&P 500 in negative territory for 2018. What's your read on that?
Well, we continue to think that the fundamentals of the U.S., Canadian, and really the major global economies all remain relatively sound, and that unfortunately in the headlines and in some of the glib analysis that you'll see in some places, there is a conflation of a slowdown with a recession. And the two are very distinct things. We don't think on a reasonable modeling of the kind of developments that we're seeing in the actual economy, reason to think that growth is going to go any lower than 2 or slightly south of 2% in North America over the next 2 years. To get into recession territory where some market indicators are starting to price, you would have to see a massive erosion in fundamentals that we don't project over the next couple of years. That said, you can start seeing an almost self-fulfilling wealth effect take hold when market asset prices get beaten down so far that people become more conservative about their consumption and spending choices, and firms become more cautious on their investment choices. That can bring about a further slowdown in a kind of vicious circle. So,
do you think we're there yet?
I don't think we're there yet because in some ways what you've seen taken out of 2018's pricing is a lot of what was really an ephemeral bump related to what was not ever seen by us as sustainable policy from the White House. In some ways, the run-up in prices you saw earlier this year reflected the big fiscal boost the White House brought in with extra spending and extra tax cuts, none of which can be sustained over the longer term because they will produce deficits in the United States that have to be corrected. And so I think in many ways the hope, which was probably misplaced, that they would lead to sustainable growth is simply being unwound.
Okay, thanks a lot, Brett. Deputy Chief Economist at Scotiabank Economics, Brett House, for us in Toronto.